Stocks overpriced ahead of this week's key economic data and earnings season just around the corner. Let's ask the Dean of Valuations, Aswath Damodaran, NYU Stern School of Business Professor of Finance. Professor, welcome back. It's good to see you.
Thank you for having me.
I feel like you've taken a bit of a bearish turn from your notes. Is that an accurate assessment of your current market view?
I am more worried than I was a couple of months ago, or even 6 weeks ago. And there are a couple of things. One is the good news for this year has been that earnings estimates have been going up. Not by a lot, but almost consistently over the course of three months as earnings reports come out. But at the same time, inflation seems to be much more stubborn than people thought it was going to be at the start of the year. So I think tomorrow's numbers are going to be pretty significant in where the market goes next. And to be quite honest, that's where inflation goes for the rest of the year is going to drive the market, not what the Fed does or does not do.
But you think tomorrow morning's a binary event? Something too hot could mean the end of this. Would you say it's the end of the rally itself?
No, not necessarily. But I think that to the extent that people have pulled back already, and I see a lot more skeptics in the market now than 6 weeks ago, it gives them another reason to stay on the sideline. So even if they're not selling, they're not buying, and that can by itself have an effect on the market. So I think it's going to be not necessarily the event, but it's going to be one of a series of events, just as in 2022, it was a collection of inflation announcements that got us into trouble. This is going to be one more piece of information we use to make a judgment on, where's inflation going? I have a feeling. Yeah, go ahead.
Sorry. No, please. Forgive me. You go ahead.
Now, I was going to say, looking at the bond market, which to me is the best indicator of what investors think about expected inflation, and you look at the T-bond rate is up from 3.88% to 4.35, 4.4%. That suggests to me that investors in the bond market are expecting inflation to continue to stay above 3%, no matter what the Fed says about that inflation.
So you suggested to our producers, and I'm quoting from the note here, the market is over-adjusted to two positive developments over the course of the last year, the decline in inflation from the heights of 22 and the receding of worries about recession. You sound like you're stealing a page from Jamie Dimon's note, where he suggests you could see a further spike in rates and that the market's just gotten way too optimistic and over its skis on the idea that the economy is just fully out of the woods.
And I agree with Jamie on that one, because I think that especially on the inflation front, inflation's history is it's incredibly stubborn. And you think you put it away for a while, but it keeps coming back. And while the probability might be low that you're going to go back to a 2022 level, there is a chance it could happen. I mean, the economy is hot, commodity prices are up. So I don't think you can rule it out. And I don't think the market's incorporating that likelihood enough in terms of pricing it in.
What's your own view on rate cuts? Because I would assume that in some respects that has to partially at least color your view on the valuation of the market.
I'll be quite honest. The Fed can raise rates, cut rates, or do nothing to rates. T-bond rates, which is what I watch. I don't care about the T-bill rate as much. T-bond rates are going to take their own path, and that path is going to be independent of what the Fed does. I mean, remember last year the Fed, if you think about raising rates, they raised the rates 3 times. The T-bond rate did not move over the course of the year. It was responding to inflation. And I'll make the same prediction for this year. On December 31st of 2024, when we look at the T-bond rate, whether it's 3% or 5% will have nothing to do with whether the Fed cut rates. It'll have everything to do with whether inflation is below 2.5% or 2%, or whether it stays above 3%.
Do you think the market's overvalued today?
I think it is setting itself up for disappointments, at least in the second half of the year. I think that if you think in terms of asymmetry, the risks on the downside are higher than the risks on the upside. I'm not one of those who sells everything and runs for the hills, because I don't think it's ever worked for me. I'm a terrible market timer. But this is not the kind of market I would jump in with both feet, because you are, I think, heading in. And it's not just economic uncertainty, it's political uncertainty. I'm surprised the market is not factoring in some of those uncertainties more in pricing stocks.
I mean, we obviously have an election not that far away. Some would suggest the only thing that really matters in the face of everything is the trend change from the Fed, that we're going to get cuts, we assume, at some point. And why fight the Fed?
You know what? I've been hearing that since the start of the year, and markets are up in spite of the fact that the much promised Fed cuts have not come yet. I'll make a prediction again. If Fed cuts rates, I wouldn't be surprised if the market went down rather than up.